Today I'm going to talk about the free stocks that I have been buying last week, so I'll go through these free stocks for you. There's going to be one value play, one dividend play and one growth stock, so we'll go through these together. Just going to say sorry there was no video yesterday, was just a bit too busy with work to kind of record a video, but it was a massive green day in the stock market yesterday, and it has been this week. It's been a great week for the stock market, so when the stock market is green, you guys don't need me. You only need me on the red days just to come on here and say everything's going to be okay, buy the dip. And yeah, it's been quite a good week for the stock market. I think for me, my stock market portfolio was up about 12% this week, so we're moving in the right direction. It might not be the bottom, so always bear that in mind, but it's been a pretty good rebound. So but anyway, we'll get stuck onto the free stocks that I've been buying last week. Now, if you do want to know when I'm buying and selling these companies in real time, make sure you join the Patreon. Link is in the description, so you don't have to wait a week later until I talk about them on YouTube. The best place to get live buy and sell alerts, and also that's where I'm most active on to talk to. As well on there, I do post 2 exclusive videos a week. So the one that's just gone up recently was a review of earnings from last week. So the stocks like Boohoo, JD.com, Greggs, National Express were all on there. So yeah, that's about half an hour long, that video. We did a live Q&A session as well earlier this week. So yeah, there's 2 exclusive videos a week on there. Discord of 600 members to talk to as well on there. So yeah, £5 a month, it's pretty good, and try not to be biased, but yeah, in my opinion, that's pretty good value. But anyway, we'll get on to the free stocks that I have been buying. So number one, we're going to start off with the growth company, which is Shopify. Now, Shopify is one of those companies that I think obviously it got to really high valuations and it was due a correction, maybe a 20-30% correction, but now we're talking about Shopify where it's had a 60% correction, and now for me, or crash, this has now come an overreaction, and I think this has created a really good buying opportunity. You look at this here now, Shopify is 681. This is prices, it's only up 26% since February 2020. And you look at a lot of the financials, like the revenue's over doubled, tripled since that period of time. So that says a lot about this company right now, down at an 85 billion valuation. And this company as well, it's a fantastic company. It's very rare for this to have dips. 2019 it had a 25% dip. In the CV crash it had a 34% dip, and now it's on a 60% dip. This is one of the biggest crashes that this company's ever had, which stands out as a really good opportunity for me to buy up some shares in this one. I've not bought it for a while, so that's why I tried to capitalize on it. Now, Shopify is the best e-commerce platform to help businesses get started. It's one that if you're a small business, a big business, you want to go to Shopify to help you set up an online e-commerce site, and that's what it is. It's just going to be so dominant in the next 5 years. It's been dominant in the last 5 years and will be dominant in the next 5 years. It's not just a platform that helps you create and manage that online site, even though that side of the business is absolutely fantastic. There's so much more to it now. This is why the company doesn't make profit, because it reinvests it to kind of expand its revenue income, and now it has so many little parts that help it with these businesses that a business basically looks at it now and go, why would we get rid of Shopify when it does all of these things for us? Imagine how many different separate businesses would have to go to get all these things. So obviously it lets you set up an online e-commerce site, but then also now it manages your payments, and as well as that, it does buy now, pay later. Capital, it's nearly a bank now. A lot of businesses that are on Shopify can actually go to them and lend money off them, and a lot of businesses said that this is actually so much better than actually going to the normal banks. So now you have a bit of a mini bank here. Marketing, helping the marketing side of it, advertising the products through whatever site they want to market to them on, analytics, getting data from them, the traffic side of it, what products they're selling, what are the keywords, apps, designing an app, or using apps to sell the products on Facebook or your TikTok or Pinterest, and this new bit is one of the reasons why there's been a lot of investment recently, which is the inventory side of it. So they can now also store your items for you, so you don't need a warehouse, fulfillment, so you don't have to ship them out, order management, they do it all for you. Shipping, once again, kind of ties in with inventory and fulfillment. Shopify has just gone from this kind of platform that helps you create a website and is very easy to do that, to all of these little things now. It's such a really good business in the long term now. And it's had a bit of a dip recently, and it dipped quite a bit off earnings, but earnings were strong. EPS was good, revenue was good. Revenue was still growing at 41% year over year. And, you look at them sort of numbers and you're looking at the drop and you think this is just a massive overreaction. And like I said, I think that you just got to two stretch valuations, but now you're having an overreaction, and maybe that they actually came out and said that Q1 might be quite a hard quarter with the comparisons, but it's still going to grow at really good rates going forward. And I think we've just been gifted a really good buying opportunity here in Shopify. I mean, just look at the revenue growth. Let's remember this is now priced at where it was March 2020. So if we look here at March 31st, 2020, they're doing 1.7 billion in revenue. Now they've just finished the year doing 4.6 billion in revenue, and even in the end of 2022, they're going to do 6 billion in revenue. So these growth rates are just absolutely fantastic as well. And the companies, for some reason, the analysts have got them down here to lose slightly more money, but it depends how much reinvestment they do. Obviously we know they could easily be profitable if they wanted to be. You look at the gross margins, they're good, but they reinvest to kind of make all these other income streams. So I don't really focus on that, but don't be too surprised if they wanted to make profitability, they do go for that. So we'll see what happens there. Financial health wise, it's really strong as well. There's only a little bit of debt, so you see there's 8% debt to equity on here, but they are currently sitting on 7.8 billion in cash, which is a fair chunk, which is really good. The only little downside that I do have is there has been a little bit of selling inside the company. That's the only little negative. On a dip like this, you'd love to see some insiders come in and buy it. But on the positive note, the top shareholder is the founder, which is really positive. Founder-led company, and they are the biggest shareholder to buy us at 6%, which is great. And if we go across to the metrics, you can see here that their total enterprise to revenues is 12. It's never been that before. The last time, it has been that before, but the last time was in the 31st of December 2018 when it was a 10. Now you might remember that's when a lot of stocks crashed. We had a bit of a mini stock market crash correction going on there. So that's the last time it was this low, which was 4 years ago. In that time, it's normally 14, 19, 47. So even if it was a little bit of a slowing growth rate, it's still really, really cheap compared to what it normally is. And on total enterprise to EBITDA as well, it's a lot cheaper as well, even though it's obviously more focused on the revenue side of it. So that's number one, a growth company which I think has had way too much of an overreaction on the share price. So I think that's an easy to exit in the next 5 years when you talk about Shopify. Next up, Barrett Development. So this is the dividend stock, but you could actually class it as a bit of a value play. So it is currently trading down at an 8 times earnings, which I do think is quite cheap. Even though house builders always do trade down at quite a cheap valuation, I do think this could be, the market average is 20. I would say that you would, these sort of stocks should be down at, maybe a 12 or a 13. So I think that this is quite cheap. And also considering it does pay a 5.9% dividend yield as well, which is why I'm mostly interested in this business. Now there's a lot of different house builders you could actually put on this list. I've had quite a few about what about Taylor Wimpey, what about Redrow, what about Persimmon. They are all very similar. They're all roughly around the same P ratio. They're all roughly around the same dividend yield. I think apart from Persimmon, which I think pays a special dividend, so theirs is actually like 10%, but I think that sometimes people don't realize that's a special dividend, so you just have to be careful with that. I guess the other reason why is why do I choose Barrett Development over them? I think the thing with Barrett Developments is that they just have there's actually a new site that's just down the road from me, and I was very interested in potentially buying one of them. The problem is they were just a bit more price out of what I was looking to purchase them for, but I always think Barrett Development houses, I'm not really a big fan of new builds, but I think their new builds actually have a little bit of personality and a little bit more higher quality that I like about them, and they have good reviews as well. You can look here on Trustpilot, they're a 4.2, whereas you look at Persimmon, for example, they're a 3 out of 5. So I think that the actual design of them are always a little bit better, and I believe the actual build quality are a little bit better, and that's why I normally go for Barratt Developments over a lot of the other house builders in particular, but there's a few other reasons on the financial side of it. I guess the only risk that you do have with buying house builder stocks is if there's going to be a house market crash, which you never know is when is that going to happen. You know, you've heard so many before that, oh, you think CV is going to crash it, and it hasn't. When the stamp duty tax relief goes out the window, that will crash it. It hasn't. And yeah, it just keeps going up and up. So that's the only risk that you do have to it. But the problem is that we just so short on houses in the UK that they will carry on probably doing well over the long term. You know, there might be a blip at some point, as there is with everything, that, you know, you can't carry on going up. It's like the stock market. At some points you're going to have your drops, and it will happen eventually at one point. But at the moment, there's no signs of slowing down. And historically, we know that house prices just go up and up and up. And going on to Barratt Developments, you know, if we just let's go on the past performance. You know, historically, revenue just moves in the right direction, profit moves in the right direction, apart from this little CV dip that we did have here. Financial health wise, once again, another reason why I like it is that it's got pretty strong balance sheet. It's only got 3.7% debt to equity, and it's got plenty of cash on there, you know, 1.3 billion in cash. Dividend, it's got a history of paying a very good dividend, 5.25% dividend yield, and you can see they've hiked that up historically. Even though there's not too many big insider ownership inside the company, there has been quite a few insiders buying as well, which is a positive. And that leads me on to my last stock, my final stock, which is a value play, which is PayPal. Now, it might be a bit questionable whether you call it a value play. It's not what you'd call, you know, the typical kind of Warren Buffett value play, but I call it value play because you are judging it off the profit as well as the revenue here. It is trading down at 32 times earnings, and this is a high quality company, so it's not going to trade down at 20 times earnings. This company historically is a bit like Shopify. It doesn't have that many dips. You know, you see here, this dip is, you know, 7%. This dip here is 12%. This dip here is around 22%, 27%. So for this one to have a 62% dip is huge. Now, same again, you might look at this and go, oh, okay, it was due a correction at some point. Fair enough. But does it deserve to go back down to, you know, pre-CV prices, you know, 2 years of share price wiped out? I think this is where you get, once again, a bit of an overcorrection here. And that's why I'm picking up some shares in PayPal. Now, I would say the valuation is the cause of most of the dip. Obviously, there was also earnings which caused some dip as well, the more recent dip. The recent earnings were kind of a bit of a mystery to me, because I looked at the earnings, thought, yeah, they're not great, but does it justify to have 2 years of share price wiped out? Not in my opinion. So the company came out with that it's going to grow at 15 to 17%, which, once again, when we talk about a company at 32 times earnings, that's a lot better than your normal average company. And the prediction was that it was actually going to grow around 18 to 19%, so not too much change really. And the profit had a little bit of a downgrade as well, which, same again, it wasn't a huge amount, it was something like 10%. But the only problem they have at the moment is they have some tough comps. Obviously Q1's tricky, and also they're losing the eBay side of the business. Now, once that goes out the window, actual PayPal will go back to growing at 20+%. Now, you consider that, okay, it's going to have maybe a bit of a choppy couple of months, but when that goes out the way, does it justify to be down at this drop at 32 times earnings? Not in my opinion, and that's why I'm picking this up. You know, inside the company as well, you know, the ex-eBay growth, when that stops coming in after Q2, that's going to make the numbers look loads better. You get Venmo with this. Venmo's growing at really good rates. You get, obviously, buy now, pay later with this as well, now that it's expanded into, which is growing at really good rates as well. So I think this is a massive overreaction in this company here. And once again, you know, you're talking about one of the big blue chips that hardly dips, you know, and look at the growth on this. You know, the revenue growth is great, the profit growth, it moves all in the right direction as well. One of the, you know, big blue chips that you want to own. You know, this is the thing, you know, a lot of people say, oh, you know, I want to have one of these big blue chips, these high quality companies in my portfolio, and then they actually have the dips, and there's always that fear around there. Like, they're going to have to dip because of a reason. You just have to weigh up, okay, is that reason going to be remembered in 5 years' time or not? You know, that's the big thing. And you've seen that, you know, you've had a lot of people that go, oh, you know, I'd love to buy PayPal at $100, and it's got there, and now people go, oh, but there's this issue, or I don't know if I like this issue now, or I'd only buy it if it gets down to $80. You can't be that picky with these sort of companies. Amazing big blue chip companies with this revenue growth and this profit growth, when they have these dips, you buy them, and normally you do very well from them. It doesn't matter if you get it at $110, $105, $100. These companies really good companies that you want to get in the long term, and you'll be happy you bought them. And it's a bit frustrating for me because I would love to buy more PayPal, build a position up in the $100 range. Now it is going a little bit above that, but at the end of the day, at $115, I'm still not going to worry about that too much. I'm still going to be buying that dip because I'll be happy to have one of these big, amazing blue chip companies at these sort of prices. So I will be buying this dip, even if it's a little bit more than what I wanted to. It's still massively off from, say, the likes of $300. And same again on a metric point of view, total enterprise value to revenue, it's a 4. It's never been that before in the last 4 years. If you look at the total enterprise value to EBITDA, it's currently down at 17, and same again, it's not been at that before. The only time it's been close to that was in 2018 during that same again, that little crash correction that we had then. So this is historical valuations for this one. So yeah, I did buy some more PayPal. I will continue to buy more PayPal. I ideally want to make it a top 5 position. If I can, I want to build it a top 3 position, but it would have to stay down here for quite a long period of time. And I feel like that won't happen because I feel like eventually a lot of people will clock onto this and end up buying it up. But as long as I can build a decent position up, ideally top 5. If it can, top 3, but we'll see what happens. I will do. So I did buy some more shares in PayPal. So hope you enjoyed the video anyway, guys. If you could, hit the like button if you're new, subscribe, and I will see you on the next video.